So next slide. Again, just reminding you of what our mission is. We're leading the way in informing and protecting the public and responding to insurance needs. Next slides. So to this next hour, we're really going to start coming down into more general health insurance requirements and the role that OCI plays with those with health insurance. So OCI has jurisdiction with as like association plans or group plans that you hear about, as long as there's 25% or more insureds residing in Wisconsin. This is like ARP or a product that you might see with Condé Nast or something that kind of is a national program. It covers a lot of risks, but as soon as there's more than 25% of the certificate holders are here, they also have to comply with Wisconsin insurance laws. We have the classifications of risk get broken down to disability insurance, which includes health. It's an older term and it's a fairly arcane term, but it is what we consider health insurance as disability insurance, because it is defined as covering an injury or death of persons caused by an accident or insurance covering the health of persons. Health insurance, as you may be aware, as you've been learning about your field, is incredibly driven by a lot of definitions and lots of terms. So just to start this, to get you familiar with some of these terms, a group health benefit plan is issued to an insurer through an employer on behalf of a group that has at least 2 employees or 2 eligible employees. And the term includes an individual product to eligible employees, even when the employer just gives them some money and 3 go and buy the same product. That would become a small insurance product. That's different from a group insurance policy, which is the employer type self-funded product, which is, so you remember we talked about ERISA. And then there's managed care, or in Wisconsin, we still use the term defined network plans, which is steering through financial incentives to use certain providers because there's been negotiated discounts. Next slide. So insurance, in particular health insurance, is heavily regulated through the Wisconsin statutes. We're mainly in chapters 628, 631, and 632 have the bulk of our laws that pertain to health insurance. Small employers are 2, so not just a husband and a wife, but 2 employees, but not more than 50. And a large group, even after some litigation on the feds, is a group of employees with 51 or more. Next slide. So we titled this coverage determinations, but it's really kind of categories of different types of health. And these are, there could be a group policy or an individual. Most of what you're going to be working with are going to be individual policy holders looking for coverage through the ACA. You're looking at fully insured, so Humana or Blue Cross Blue Shield or Anthem is a fully insured product. And you're also going to see people come to you and say they have an employer plan, and it may be self-funded, and that's going to be handled by the government. You have large groups and small groups, and there's a small group on exchange group called SHOP, and we'll get more into that later. Wisconsin employers or out-of-state employers, but who may have a presence here. So a company may be headquartered in Connecticut, but have a base of their operations here in Wisconsin. And again, as long as they're selling a product and the persons are in Wisconsin, we're going to be looking for them to comply with Wisconsin insurance laws. You're going to have the employer so in an employer plan, the employer is actually the policy holder rather than the individual employees. They get certificates. You have associations where everyone's kind of a member and there's a master contract. In the ACA, you may have heard lots of different terms. One is a grandfathered plan. And there are fewer and fewer of those existing currently, and grandfathered plans are plans that were in existence at the time of the passage of the ACA and have consistently been in practice without substantial changes to the benefits since that time. You have transitional plans, or sometimes called grandmothered plans, and those are, for the most part, complying with most of the requirements under the ACA, but they get exception for certain benefits, and they don't have to coincide with a January 1 start date. Many small employers are still using this, and that is the most frequent place where it is. The feds keep extending this allowance to keep your insurance the way it was, timeframes, and the state of Wisconsin has followed suit. So annually since approximately 2014, we have been extending the time or the deadline of when transitional plans must end. I'm not sure, I don't have a crystal ball if we're ever going to see them end, but I think it would be less confusing in the marketplace if everyone was kind of onto the same place at the same point in time. Employers have enjoyed having some of these flexibilities that exist with transitional plans. Plans in Wisconsin who are qualified health plans, and we'll define that for you shortly, have to follow a set of essential health benefits. And those were set with between negotiations with the state of Wisconsin and the federal government's Centers for Medicare and Medicaid Services. But there are some entities that are large employers who can choose which state's benefit plans they want to use. So an example, in the state of Wisconsin, the state of Wisconsin Employee Health Insurance Plan is actually following the benefit plan of the state of Pennsylvania, not Wisconsin, but they are also adding the mandates that are written in by statute. You can have major medical insurance, which is in your, think traditionally comprehensive health insurance, or you can go anywhere. It's, an 80% coverage of insurance with a 20% copay, and you can go anywhere in the United States, basically, and it's going to follow you. Or you can have managed care, which is going to be a specific network of providers, a specific group of facilities, a specific group of services, and only in a specific service area. We have HMOs, health maintenance organizations, PPOs, preferred provider organizations, POS, point of service types of plans, and EPOs, exclusive provider organizations. So an HMO can be an open panel, which means you have a lot more flexibility in who you can see, or a closed panel, and that for those in or around Dane County would be Dean Health Plan with SSM. They have a closed panel. You have to get permission to go off panel. A PPO is going to have a network of preferred providers from whom you can choose. So it's a little bit more open than just an HMO. POS is even more open, being a point of service. It's a contract, again, it's much more closer to traditional insurance, where you have coverage basically wherever you kind of want to go, with maybe some limitations. The newer product that has come out, probably starting around 2016, that we first noticed at OCI, are these EPOs. So these are super skinny, exclusive networks. So not just are you restricted to, let's say, the Dean providers, but a subset of the Dean providers, or only the Dean providers in Madison, or only the UW Health Courts providers in Madison, not any of their other clinics. So when you see an EPO, that should be a flag to be very careful to make sure that all your needs are going to be met within that coverage, because there is no coverage outside that exclusive network. There are accepted benefits, and I'm going to do the next slide to explain some of those type products, that they're only doing a certain piece of health, or short-term limited duration plans, the STLD. Those are intended to be gap products. So not to be your all renewing policy, but just to cover maybe a transition coming into a new state or to a new job. And so we're going to we're going to talk about each of these, but these are all terms you're going to see. Next slide. So on different types of accepted benefits, so you can get like an accident only. You see like Aflac commercials. They're going to pay a set dollar amount if you have an accident. So regardless of what your bills may be, you're going to get $100. So none of these really make up a comprehensive product. One of the things that you may see as a navigator or a CAC is someone saying, well, I have all these coverages, so I'm all set. They may have a blanket accident and sickness policy that may be through like AARP or through another association. Again, those are not going to be comprehensive. They're going to be very specific. They may have pre-existing condition limitations, and they're going to only be for new onsets. Critical illness. So there's going to be, like if you have an emergency situation, that's the only time that policy is going to pay. And again, it's most likely going to pay a set benefit, $100, $50. Dread disease are usually all the different types of cancers, or in this case, think of illnesses, neurologic illnesses, or Parkinson's, some of those diseases that you want to be sure that might run in your family, and you want to be sure there's extra coverage so that if you become diagnosed with that disease, then that policy will pay $50 a day for so many days or for so many treatments. Cancer only policies exist, and again, that's only if you receive a diagnosis of cancer. There are HIV indemnity policies. Again, they're indemnifying you against the chance of you getting HIV, and then they're going to pay you a fixed amount. There's intensive care policies. What happens if you end up in an ICU and you're concerned about being there for 4 months and you're not going to have enough coverage? So you can buy this for another piece of insurance in your mind. Hospital indemnity is if you get admitted to a hospital. Again, it's not covering the cost of the care provided to you. It is going to pay you $50 or $75, whatever level you purchase in that agreement, or a sickness only policy. These are all what we call fixed indemnity policies. These are not based on the bills that come up for the care you receive when you're in any of those situations, but instead are tied to an agreement, your contract with the insurer, that you're paying X premium, that if you have an accident, they are going to pay you $50 a day for 2 weeks. What some less scrupulous agents may do is sell you all of these because they may be able to get commissions for all of these. But when you look at it, you actually really don't have coverage for day-to-day healthcare, and none of your bills are going to fall under this. These are all indemnity payments. Next slide. Eric.
Thanks, Julie. So moving on here, the next slide is types of policies and coverage. You can see the list there that we're going to discuss: comprehensive health insurance, qualified health plan, Medicare supplement, Medicare Select, Medicare Advantage, Part D prescription drugs, long-term care, and then short-term limited duration plans. Medicare supplement policies provide coverage for some of the costs not covered by Medicare A and Medicare Part B. With regard to Medicare Advantage plans, they provide the same coverage as Medicare, but they also provide supplemental health insurance coverage as well. Medicare Part D is the Medicare program that helps you pay for outpatient prescription drug costs. And moving on to the third bullet point, long-term care. The phrase long-term care refers to a broad range of services you may need for an extended period of time because of a chronic illness or disability. It usually does not include the type of care you receive on a short-term basis following something like a hospitalization or an acute illness. Long-term care includes medical services such as nursing care or therapies. It also includes supportive services such as help in bathing, dressing, getting in and out of bed, taking medicines, or preparing meals. The long-term care can be provided in a wide variety of settings. That includes nursing homes, your own home, an adult daycare center, group living arrangement with supportive services, Community-based long-term care is often given by family and friends, but may also be provided by paid individuals or agencies. Some of these paid individuals and agencies are licensed by the state and or they're certified by public funding programs like Medicare. Moving on to the next slide, which is short-term limited duration. So short-term limited duration is a type of health insurance coverage that was originally designed to fill temporary gaps in coverage that occur when a person transitions from one plan to another. But there's definitely some times where individuals use this plan as their overall health insurance, and they move from short-term plan to short-term plan, but that was not the original intent. Short-term limited duration coverage is exempt from individual market requirements because it's not considered individual health insurance coverage under the Public Health Service Act. Digging a little deeper on the next slide, inside short-term limited duration plans. One key point about these is that people cannot use ACA subsidies toward short-term plan premiums. Short-term plans can, and they typically do, exclude coverage for pre-existing conditions. So what the plans do is they employ a prudent layperson standard regarding pre-existing conditions, and some plans even include that standard within their definition of the pre-existing condition. The prudent layperson standard states an undiagnosed condition that produced symptoms which would have caused a reasonably prudent person to seek treatment is considered pre-existing if those symptoms arose during the look-back period of the plan. Many plans state that conditions that developed under the prior plan, for example, if they renewed the policy, that will also be considered pre-existing. And there's also post-claims underwriting that takes place within these plans oftentimes. An insurer can review the consumer's medical history, determine if there were prior symptoms that would have caused, again, a reasonably prudent person to seek treatment. And then they can use that basis to deny the claim. Just one consideration now that with regard to COVID-19, given the potential long latency between initial infection and sickness with COVID-19, short-term plans may be riskier in the current environment than they usually were because of the current pandemic. It's a situation with the latency period, it may be something where the short-term plan may not cover COVID-19. Moving on to the next slide, healthcare sharing ministries. Julie touched on healthcare sharing ministries a bit in the first hour. But again, we want to stress that healthcare sharing ministries are not insurance. They're not required to cover pre-existing conditions or cap out-of-pocket costs or cover essential health benefits. And they can still have annual and lifetime benefit caps. As you can see there on the slide, membership is limited to people who share a common religious faith typically and who agree to a variety of various rules. You can see those listed there. Some healthcare sharing ministries do help to negotiate expenses on behalf of the member, like an insurance company would, but many do not offer this service to their members. And unlike traditional health insurance plans, there's typically no provider network. So the member of the healthcare sharing ministry can visit the provider that they choose, unless they are in one of those ministries that does restrict that, but many don't. There are over 100 healthcare sharing ministries that are certified by the Federal Department of Health and Human Services as meeting the minimum requirement to meet the individual mandate under the ACA, which requires everyone to have health insurance. Next slide, please. So again, healthcare sharing ministries are non-insurance entities in which members share a common set of ethical or religious beliefs and then share those medical expenses among members in accordance with those beliefs. The ACA permits healthcare sharing ministries to meet the individual mandate for coverage, as I previously stated, but there is no federal oversight under the ACA for healthcare sharing ministries. And they're not a discounted insurance program, and they're not traditional health insurance. Again, they work by having the members band together to share medical expenses. And what typically happens is the individual pays up front and then the costs are shared at a later time. Healthcare sharing ministries require startup fees typically and regular administrative fees, and oftentimes these are non-refundable. The members make a payment to a central office or entity. Then that entity makes decisions on what will be paid and what won't be paid. Members typically many healthcare sharing ministries limit the amounts that they reimburse, also have coverage limitations as well. And the monthly sharing expenses may vary. As you can see there on the last point, you may pay more, for instance, if you have dependents than a person within the healthcare sharing ministry that does not have dependents. Next slide, please. And we've touched on this already today, but again, what is not insurance, what the Office of the Commissioner of Insurance does not regulate are self-funded ERISA plans, labor union health and welfare plans, discount plans, Medicare Advantage, Medicare Part D, healthcare sharing ministries, as I just discussed, and direct primary care. The Wisconsin Office of the Commissioner of Insurance does not regulate any of these that are listed here on this slide. And we'll move back to Julie for the next slide.
So again, with these, the ones that are not insurance, there may be components that we might still touch, but for the most part, these are ones that were regulated by other entities or are not really regulated by anyone, like healthcare sharing ministries. In the federal laws, I went through these just previously. Again, Medicare is typically for those who are older and who are 65 or older, people with certain disabilities under the age of 65, or people with end-stage renal disease. The reason you're seeing these again, ERISA and COBRA, the Mothers Health Protection Act, Women Health and Cancer Rights Act, HIPAA, Mental Health Parity and Addiction Equity Act, MAPIA, and the ACA. If you're dealing with health insurance, more than likely you're going to see one of these laws or acronyms come up during your time. And it's important to remember at least what they are. So HIPAA really focused on the portability of insurance. It was the first time that you could, if you'd had a health condition, you could actually change your employer and not worry about getting continued coverage. Mental health parity is making sure that mental health services are on the same level as coverage for medical conditions. The ACA kind of also then created the marketplace. The Mothers Health Protection Act allowed how much time you'd be protected to be in the hospital. They couldn't do drive-through deliveries of babies. They actually had to provide at least 48 hours of care or 72 hours with C-section. But these laws are, for the most part, enforced by the feds, not by the states. But components are going to fall under each of the states' requirements. Next slide, please.
And then actually, real quick,
so
before
the ACA, lots of acronyms, Obamacare, the Affordable Care Act, any name you'd like to use under the sun, but it's the same thing. The ACA was one of the biggest significant changes to health insurance since the passage of Medicare. This was enacted in March of 2010, and it addressed quality of care, cost of care, accessibility, gaps in insurance, and it started reforms that for many states they did not have, bringing in minimum coverage, taking away annual caps and limits or lifetime limits, prohibiting, making sure, mandating that all essential health benefits are covered and covered preventive care services without cost sharing, guaranteeing health insurance policies, and prohibiting pre-existing condition limitations. It was a monumental movement. The insurance exchange or the marketplace, we use those terms interchangeably. The ACA provided that beginning in 2014, with the implementation of the health insurance exchanges or marketplace, the federal website now allows consumers to purchase qualified health plans, those that are qualified to meet all the requirements under the ACA and states requirements, and are determined for a federal premium and eligible on the exchange, potentially for premium tax credits or cost sharing subsidies. The federal government uses the term health insurance marketplace. We often, in Wisconsin, you may hear exchange. The feds the feds use regulations as well as laws, but they also issue what is called sub-regulatory guidance, which may be memos or pronouncements, or sometimes letter opinions. These sometimes are not conducted in the same manner as formal rulemaking that is open comment periods and is a little more transparent in its process, but still has the weight of the federal government. There are case laws that are pending right now to repeal or change parts of the ACA. Big case will be heard potentially in November. Even after the passage of the ACA, though, OCI's mission remained the same. So although it was a monumental change, it did not change what we do as the primary regulator of health insurance in Wisconsin. And one of the things that we'll also show you is some of the things that we had in existence prior to the ACA that was unique to Wisconsin. Next slide, please. So again, beginning in 2014 was the first time people could go on to the marketplace. Health insurers were required to sell plans to anyone who applied for coverage as long as they lived in the service area. They could no longer refuse or limit coverage based on a health status. Individuals and small groups can get coverage for all the essential health benefits. And as of 2020, out-of-pocket expenses were capped at, it seems like a lot of money, $8,150 for an individual or $16,300 for a family. Understand there are some benefits that can help make this more affordable. Next slide. So the market reforms, so pieces of this, insurers can only vary premium for a particular plan based on these criteria, where the coverage, whether the coverage is for an individual or a family, where in the state that plan is sold, so geographic uniquenesses, age, and tobacco use. And now it's only tobacco use above the age of 21. Because that's the law for where you're supposed to legally be able to get them. The plans are categorized into metal tier levels. So by now you've gotten familiar hearing these, and those are based on an actuarial value, meaning the average amount of covered health services for the plan is expected to pay. So a bronze level plan is expected to pay 60% of the healthcare expenses, where a platinum plan is going to cover 90% of those costs. And the remainder is for administrative, and they can't exceed those other percentages. The ACA provides comprehensive individual and small group health insurance plans with these tiers. And there's also a catastrophic plan for persons who are 30 and under or someone who qualifies for a hardship exemption. Initially, it was often individuals like farmers who had not enough sufficient funds potentially, or funds weren't regular throughout the year and could become eligible for this catastrophic plan. Next slide. So for 2021, upcoming, this is all of why you're probably here, is open enrollment is set to begin November 1st and runs to December 15th. If someone enrolls during that open enrollment window, their coverage is going to start January 1st of 2021. If someone needs to enroll, and that we'll explain a little bit more, outside this window, the November 1 to December 15th window, they can only do so if they qualify for a special enrollment period, and that's the acronym is an SEP, and we'll give you details on what those are. If someone doesn't pay by the 15th of December, their insurance is not going to start on January 1st, but may start later in the month or at the end of the month. So being timely during this window is really important. And the other thing to stress to y'all who are listening is even if you have a client who's been in the exchange before, it's really important every year to go back in and make sure that your information is accurate, that is contained in the exchange. Make sure that the income levels are right. Maybe you've had a change because of COVID and your income is lower. or maybe higher. You've had more people move home who are truly dependents and under the age of 26. You may have had to move and make sure that the geography is right. So it's really important to make it a habit to go in and make sure your information is right, and then affirmatively look at what your choices are. You may be eligible for more assistance based on some of your changes for the coming year, or plans may change. Next slide. So this special enrollment opportunity are available for individuals to enroll at any time outside that open enrollment window, November 1 to December 15. And examples which would allow you to have this enrollment would be loss of coverage through your employer, or loss of coverage because of a divorce or separation, a change of your residence, moving, no longer being eligible for Medicaid, newly obtained citizenship, or a life event, a baby, marriage, adoption, or a child placed with you for foster care. Those are going to give you a finite window to, again, have this new opportunity to enroll onto the marketplace or enroll into insurance. And insurers off the exchange also need to be providing this SEP. The difference is the tax advantages or the assistance that may come on the ACA that are not offered off the exchange. And to try to highlight some of these just quickly, if an insurer offers a group health plan, and do they have to provide an open enrollment period? They do when a person gets married, if they have a child or adopt a child, if they've met a waiting period. Some employers have waiting periods. If they've met that, they need to allow them to have an opportunity to enroll. If they've made available, now that you can cover dependents up to 26, maybe a dependent life status change happened for your dependent, and now they need health insurance, and they can get it through you through an SEP. Our next slide is a polling slide, and I think we're still reading those. So special enrollment periods allow individuals to enroll in the ACA outside the normal enrollment period when the person, A, decides a different plan would be more cost effective, B, receives a promotion at work, C, loses eligibility for Medicaid, D, is diagnosed with a severe illness. And I'll be watching the chats to see how you all are doing. And the chat that I'm seeing is C, yes. When you lose eligibility for Medicaid, that does set up a special enrollment period. Next slide, please. So again, for the 2021 open enrollment period, Wisconsin actually has a very competitive marketplace. And in 2020, we had 15 insurers on the exchange. For 2021, it's looking like 24 insurers are going to be offering products in the individual and small group market. Some insurers are only in the small group market, some are in both, and some are just in individual. But our marketplace options are growing in Wisconsin. On the exchange, insurers must offer the same plan off exchange as well. So you don't have to go through the exchange if someone doesn't want to. They'll find similar plans. Occasionally, they may find a very similar plan with maybe an added benefit or a lesser benefit at a different premium cost. So depending on your clientele, you might that might be something they want to consider, but you'll be focusing on helping people get onto the marketplace that are eligible. And we will, on this link is a good link for you to keep. We do keep an interactive map, and we will be populating this again in late October in advance of the open enrollment period, where you can find out by clicking on a county what insurers are offering coverage and what level plans they're offering. If they're offering, catastrophic through platinum, or if they're offering silver, or what level they're offering. You will also see on this website who the second lowest cost silver plan is, and that's important information because that's how advanced premium tax credits and cost sharing reductions are based off of that dollar amount in that county. So it's part of the calculus. And now I'm going to switch back to Eric on slide 21, please.
Thank you. Okay, moving on to slide 21, interest on claims. As you can see there, it states requires sufficient documentation to make a determination of liability, and interest on claims may occur if a claim wasn't paid when it should have been paid. The slide discusses the vendor situation where the vendor may not see error notifications that may result in a non-payment of a claim, and thus would be subject to interest. Even though it may be unintentional, it's still subject to interest in that situation. And the third bullet point there talks about influx of complaints after conferences about medical claim processing. OCI does certainly see some patterns when there are conferences regarding medical claims. We oftentimes do get more complaints after these conferences occur addressing medical claim processing. It goes on to state that interest doesn't apply to Medicare Advantage or Medicaid and does not apply to providers with provider agreements either. Next slide, please. So we're getting back to pre-existing conditions here. We did touch on this a little bit earlier today. As you can see, they're not allowed under ACA qualified health plans. They are applicable to short-term limited duration policies and fixed indemnity policies. Subject to the ACA, insurers have been prohibited from imposing pre-existing condition limitations on individuals insured under the plans. Policies not subject to the ACA may continue to have these pre-existing condition limitations subject to the following. For an individual disability, accident and health insurance policy that's not subject to the ACA, no claim or loss incurred or disability commencing after 12 months from the date of issue of a policy may be reduced or denied on the ground that a disease or physical condition existed prior to the effective date of coverage, unless the condition was excluded from coverage by name or specific description by a provision effective on the date of the loss. For a limited benefit insurance policy, such as a hospital indemnity policy or an accident policy, the pre-existing condition limitation may apply for up to 2 years from the date of policy issue. And for policies other than group health or comprehensive individual health policies subject to the ACA, if a policy has been in effect for at least 2 years, any claim for loss or disability that occurs after that 2-year period may not be reduced or denied on the grounds that it was a disease or physical condition that existed prior to the effective date of coverage. The only exception to that, again, is when the condition is specifically excluded. The one other important note on pre-existing conditions is that the definition used is different from what a physician or other healthcare provider may define pre-existing condition as, and medical records indicating chronic or recurring conditions or diseases also comes into play. The next slide, please, deals with appeals, grievances, and independent review. If so, in a situation where you disagree with your insurer's determination on whether they're going to provide coverage, the insured does have a right to appeal that through the grievance process. A grievance is any dissatisfaction with an insurer offering a health benefit plan or administration of a health benefit plan by the insurer that is expressed in writing to the insurer on or on behalf of an insured. So all insurers that issue health benefit plans must develop an internal grievance procedure. Health benefit plans do not include accident-only or disability income insurance. Insurers are required to file with OCI an annual grievance report. Also discussed in the slide are independent reviews. And an independent review may be requested whenever a health plan denies coverage for treatment based upon a medical judgment. The independent review process provides an insured with an opportunity to have medical professionals who have no connection to their health plan review a dispute. The IRO assigns the dispute to a clinical peer reviewer who is an expert in the treatment of the disputed medical condition, and the IRO has the authority to determine whether the treatment should be covered by that health plan. Again, the reviewer is not affiliated with the insured, they're not affiliated with the medical provider, nor the insurer, and they conduct an independent and unbiased review of the claim. The IRO process is intended to be an easy way to receive an independent decision within a relatively short time frame. And the final bullet point on that slide does note that OCI does not make medical determinations, and that's why the resolution must be through grievance and IRO, because OCI is simply not going to make a medical determination. That brings us to the next slide, which is the polling slide. And it's which of the following is true? A, short-term plans are required to provide coverage for pre-existing conditions. B, qualified health plans under the ACA are required to provide coverage for pre-existing conditions. OCI is able to make medical determinations regarding pre-existing conditions. Or D, filing an action in court is the only way to resolve disputes regarding pre-existing conditions. Okay. All right, and it does look like most people did answer B, which is the correct answer. Qualified health plans under the ACA are required to provide coverage for pre-existing conditions. Next slide, please. Slide 25, medical necessity. Medical necessity is not defined by statute or rule. It's defined actually by the insurer. So the insurer makes the decision whether or not the treatment or procedure is medically necessary. If the insured or the provider argues it is medically necessary and the insurance company disagrees with that, then the insured may request a grievance in an IRO hearing, as we discussed in the previous slide. Again, we discussed this earlier, but it's different than a physician's or other healthcare provider's definition of medical necessity. Again, OCI does not make medical determinations, which necessitates that the resolution is through grievance at IRO. And that shows you a couple examples of complaints on this: number of physical therapy sessions, latest DME product. And just again, we never get involved with medical determinations. Moving back to Julie for the next slide.
So starting with coordination of benefits. This is one of our more complex areas and one that we will be updating in the next biennium. This is where someone may have multiple insurance policies and trying to figure out who pays first and which payer in what order is required to pay. And it is actually established in a very set sequence. And this most often comes up in a family that has two parents that might have different coverages through their employers, but the kids are covered under both plans. And the question is, who pays first? And one of the examples of how to make that determination is whose birthday of the two parents comes first. Not year, but month. So if it's you have someone who has an April birthday or an October birthday, the plan of the spouse with the April birthday is going to come first, they're going to be the primary plan to pay first. Any residual will then go on to the secondary payer in coordination. So we'll be updating. This is going to be moving, but we try not to have people overinsured. Right now, you can have these different policies, and the best way for us to regulate that is through this regulation in INS 3.40 that lays out a sequence. It's a very finite sequence, and the first one that you match is where you stop looking. And we go through each one of those when the issues come up. Insurers are very good at figuring out when they're the first one or not. Occasionally, those are complaints that do come to the office for us to help walk through who's the primary insurer. And the difference and the reasons it's important is maybe there's a benefit that's under one policy that's not under another policy. And so the claim has to be processed through the primary plan before it can go to the secondary plan, even if it's only in the secondary plan's policy that procedure may be covered. So it's to keep, again, level playing field, and again, an opportunity for everything to be fair and above board. Next slide. So network adequacy is something the office watches very carefully, and insurers are required to submit plans and attestations to the office that demonstrate they have sufficient number and type of providers to adequately deliver all covered services based on the demographics and the health status of the current and expected enrollees by that plan. So there are going to be geographic differences within the state of Wisconsin. Some areas are fairly rural, and it may be typical that you have to maybe travel 15, 20 minutes. It may be different in a more rural area that it may be more like 45 minutes. Or a network adequacy could be met if you have 2 OBGYNs in a service area, but the population demographics for your plan have a lower percentage of females or female at childbearing age. So it is an analysis that we do and expect the plans to do at the geographic level, at a provider level, and the ACA also requires that there are certain types of providers that are required to be accessible in this network in order for it to be considered an adequate network. When you're assisting consumers, EPOs, again, they're exclusive provider organizations, have very narrow, very skinny, sometimes you've heard skinny plans, networks, and but can still meet the network adequacy. So if you think of Marshfield Clinic, if you can only see Marshfield Clinic, you're seeing a lot of providers. With an EPO, you just can't go off that network. And it may be, again, there could be a subset of that. Again, think UW, they have locations, UW Health, throughout the state of Wisconsin. So maybe you have an EPO that is just Madison versus a bigger geographic area. So when you're looking at an EPO, be sure you're looking very carefully at what that network is. But just because it is a skinny network does not mean that it automatically won't have an adequate network. We are going to be requiring that they do. Our consumer affairs section of the office, if you hear things like it's taking 8 months to see a primary care provider for a physical, or I can't get into a dermatologist for 12 months, we want to hear about it. And we'd love you to use your reach out to us through a call or through a complaint, because you're on the ground and able to see and consumers, what's happening in the field versus what might have gotten filed with us. One of the benefits we have of being an agency with a very long history is we also have really good relations with our insurers. So it is not unusual for insurers to have some negotiating problems with provider groups. We often get a heads up that the main provider group for Grant County is having some difficulties in their negotiations. and if they cannot get resolution, they're going to have a network problem. That insurer frequently will call us way in advance or the provider group and say, you need to pay attention. And then we're going to start watching very closely that we want to make sure that consumers who have bought that product have access to a sufficient and appropriate network of providers. To double check that that is happening, we do conduct desk audits, which is we'll ask questions that have to be responded within a very tight time frame with lots of documentation, or we may go on site to insurers and double check their files and make sure that they are providing sufficient, demonstrating that they have actual contracts with addressing these issues. And we're also going to look at the complaints that the insurers are getting directly. Maybe someone's calling the insurer and saying, I can't get in, and they're not letting us know, or they're not complaining to OCI. We'll see that on a desk audit, on an exam, or on a review. Next slide, please. So under the ACA, you have, there were some changes to these out-of-pocket maximums and how they affect structures. So all ACA compliant plans now, as of 2016, I believe, have to have embedded out-of-pocket maximums. As a result, most ACA compliant plans now do indeed have these embedded deductibles, which help relieve financial stress for smaller families. All family deductibles must be no more than double the individual deductible rate under the ACA. For example, if the individual deductible is $3,000, the family deductible cannot be more than $6,000. And this is a way also to help alleviate the stress on smaller families. And to better explain embedded and non-embedded, if we move to the next slide. So deductibles are the amount of money that must be paid for services before the insurance company is going to start paying on that claim. An embedded deductible means each family member has an individual deductible amount in addition to an overall family deductible. So if an individual in the family reaches his or her deductible before the family reaches their deductible, his or her services are going to be paid by the insurance company before some of the other members of the family. A non-embedded deductible is where you either have they may say there's an individual deductible and a family deductible, but if you have family coverage, your family must meet the family level deductible before the insurer is going to start paying, even if one family member would have met what is denoted in that policy as the individual deductible. So non-embedded deductibles can be more problematic, especially for smaller families or families who have some member of their family who tend to have more medical issues than others, because like in the embedded, that person may meet their deductible early and there's assistance for financial help on their claims earlier than this non-embedded where you need to meet the family deductible first. And then I'm going to hand over to Eric. Next slide.
Thank you. So next slide is Wisconsin insurance mandates, and Wisconsin does have insurance mandates. These are items that are required to be covered. You can see the couple bullet point there, examples. Moving on to the next slide, alcoholism, drug abuse, and mental health. Wisconsin's mandate applies to all group health plans, policies covering hospital care, with an exception for groups of less than 10. The ACA provides a mental health and substance abuse or substance use disorder services, including behavioral health treatment, are essential health benefits. Wisconsin's mental disorders, alcoholism, drug abuse, and other disease mandate provides that the following must be no more restrictive than the most common or frequent type of treatment limitations applied to other coverage under the plan. This includes policy exclusions and limitations, deductibles, co-pays, co-insurance, annual and lifetime payment limitations, out-of-pocket limits, out-of-network charges, day, visit, and appointment limits, limitations regarding referrals to non-physician providers and treatment programs, and duration or frequency of coverage limits under the plan. Group health policies are required to provide coverage for transitional mental health alcohol, and other drug abuse treatment arrangements, such as day hospitalization. Next slide. The slide deals with preventative care services. Preventive care services not subject to cost sharing when delivered by the doctor in the insured's network. COVID-19 immunization, when developed, will be a preventive care service. So if the appointment is for preventive care, it's not subject to cost sharing. However, if the appointment is for a specific complaint and while you're there, you receive a preventive service, the office visit is then typically chargeable and subject to cost sharing as well. So we often do see that where we may get a complaint where the consumer is upset that they've had a preventive service and are still getting charged or have to or are subjected to cost sharing. But the reason is that if they're there for another item that is subject to cost sharing, then that is permissible for the provider to bring forth that cost to the consumer. And then I will now flip it back to Julie for slide 33.
So continuation rights in group health insurance products, you've been hearing more about this, especially with COVID and some of the uncertainty in employers. There is both state and federal coverage to give certain individuals who would otherwise lose their group insurance a right to continue their coverage for a specific period of time. Most employers with 20 or more employees must comply with the federal law, which is COBRA. And it's potentially up to 18 months for the employee, the spouse, or the dependents, and 36 months if there was a loss of insurance due to the death of the employee. Wisconsin continuation is any size. Doesn't start at 20, and it also allows the continuation of that group product. The big thing to remember for the continuation rights is that unlike the ACA, this premium now for this group insurance, the consumer who wants to continue with that product is going to be paying the entire premium. Typically in health insurance issued by an employer or through an employer, the employer is paying a portion of that insurance premium and sharing that cost with their employees as a huge benefit to their employees. If you choose to go on continuation, though, you're now going to pay 100% of that premium. So you lose the employer's benefit of what they were paying. The employer is the one who has to give you notice of this right to elect continuation, and your time window for making this election starts when you get notice. Let's go to the next slide. So again, for the state, it's in section 632-897, and it covers most policies in Wisconsin. And for people who have been at least employed for 3 months, and you will get at least 3 months of coverage or until an employee moves. Continuation will end if you fail to pay premium, or your former spouse loses eligibility for the group when you divorce that spouse. This is something to remember. Although these rights exist as an option for consumers, this is also an opportunity potentially for an SEP, a special enrollment period. And you need to be, when you're advising people about options that they have, it's really important that they understand the full range of options, including the marketplace, because the marketplace may be more affordable. So if you are seeking continuation rights because an employee, through no fault of their own, is let go, they may not, your income level may change, and you may now be eligible on the marketplace for advanced premium tax credit assistance or cost sharing assistance, and get comprehensive insurance at a much more affordable cost. Next slide. So in order to get continuation, it can't be for gross misconduct. Again, the employee is now going to be paying 100% of the premium. This SEP is important. If you are going to do this, you need to do it right away, because if you choose continuation and then realize this is too expensive, you are not going to get another SEP. You have to wait until the open enrollment period in November or December for you to get onto the exchange. So once you start with continuation or COBRA, you must exhaust it before you're going to get another window to get onto the marketplace. And again, employers are the ones who do the notification and start the clock on this time frame. So we've been putting out a lot of information during this COVID pandemic because of this option that people can have as an SEP to go on for maybe more affordable health insurance. And the last slide, please. These are resources, and I'm not sure if I can have the ball or sharing my screen, but also, let's see if yeah. Okay, just a sec. I have two screens and I have to go the right arrow direction.
Mike, are you able to help, Lee?
I am able to control her screen now. She's the presenter, so she is.
Okay,
She will have to
she's
control
got
the
it.
screen, unfortunately.
Yeah, looks like you got it taken care of.
Okay, what I'm trying to have you do, and I'll try to slide it to the other screen, is to go to the OCI homepage. So it's oci.wi.gov. And if you go to that homepage, there we go. If you go to our homepage, you can find tons of resources, including these policy form checklists, which are going to tell you what is required covered within each types of policy. You're going to have under regulations our bulletins, which give guidance and opinions from the office. Tons of consumer publications. So if you're confused about continuation or COBRA, we have a really good publication about that. We also publish annually this Wisconsin Insurance Report, and it will give you a lot of statistics of what we are doing and things that we're seeing as trends. Wisconsin Covered is a new venture that came out earlier this summer between OCI, Governor Evers, jointly launched this to connect Wisconsinites with free expert help to get healthcare coverage. It's available in English, Spanish, and Hmong, and it helps put people in touch via phone with organizations like Covering Wisconsin and the United Way 211. These experts can help families understand coverage options and determine if they qualify for free coverage or lower cost coverage through Badger Care, or if they may be able to get on the health exchange with assistance. This is a really good resource additionally because for your test studying, in here you can type in Navigator and you will get a whole page of information for that is pertinent for your getting ready for your exam. So there's FAQs, frequently asked questions. There are frequently asked questions for CACs, how to take the tests, and just a wealth of information. So thank you for letting me share my screen. This is just a good spot for you all to land once in a while and roam around in, because it will help you understand lots of what's going on in the marketplace, as well as announcements like which insurers are going to be offering in which counties for the 21 open enrollment season. I'm going to stop sharing. Are there any questions that have come in that that are available, Adam or Mike?
Yeah, and this is Allison, and I don't see that we've had any other questions. I'll give people just a few minutes to type in anything that they want to yet ask. But thank you just right away, Julie and Eric, for all this terrific content. And I know that we ended up having to go longer than we anticipated today, just given those early delays. And so thanks everybody for hanging in there. This should be probably your longest day. I think the rest of them will be a little bit shorter. And so we'll have Julie and Eric back tomorrow to finish up those remaining two sessions. And I don't see any questions. And for sure, since you guys are going to be back tomorrow, if people do have questions, they can ask you then. So.
And actually, there is one question that just came in.
Oh,
Is there
okay.
a time limit for COBRA? How long until a person loses the opportunity to enroll?
Great question. It's a 60-day window. It's from the date of notice again. There are some exceptions. So if you run into a consumer right now who's having that issue, they're under FEMA, under the Federal Emergency Act, there is some extensions that have been in place because of the COVID pandemic. And I can get a resource pulled up for tomorrow, but it can extend that window to the full, to a longer period to allow more time for people to get coverage. So thank you for asking that question.
And then we did have another one come in real quick. Does an insurance company backdate for an SEP, or when would your policy become active?
That's a good question. So the policy is going to become active depending on when in the month you paid your premium. If you pay your premium for coverage at the beginning of a month, it will become eligible on the beginning of the next month. If you know that your employer is going to be ending and you got advance notice and you don't want it to start till, let's say, May instead of April, you can, one, pay your premium a little bit later, or two, ask for a delayed start date on that premium. But most policies automatically will start depending on what date in the month you get your premium into the insurer.
Great. And, you know, I think to that also, you know, the rest of the conference also for those, you know, we'll continue to talk about, I think you had mentioned the FEMA SEP. I know Adam is planning on mentioning that. So there's a lot of information, but it's, you know, you'll continue to hear about these, putting them into context, hearing from different stakeholders. So you'll get there, trust me. But thank you again, Eric. Yeah, go ahead.
Thank you. Tomorrow is really focusing on the ACA, the Navigator CAC requirements, and then walking through kind of a decision process that you would have with a consumer. So I hope you are able to join us tomorrow.